Welcome to the channel JIV and CIV Made Simple. In this particular video, we are going to quickly revise our Module B of IIBF CCP, right? That is Credit Certified Professional. The module name is analysis of financial statement. So we will try to cover the entire module, right, point wise, bullet point format, through which you can revise all the important point. Just give me 60 minutes and you will be able to understand each and every point very easily. So I will give you some example. I will take some example in between to make the conceptual clarity, and I will explain in the as much lucid manner, as much layman manner as possible. So let's get started. First of all, there are four types of first of all, financial statement analysis help us understand how strong a business is financially. It is a key tool for both investor and the lender to make a smart decision. So friends, financial statement analysis, it helps us understand how strong a business is financially. It is a key tool for both investor and lender to make a smart decision. Now, what are financial statement? So financial statement are just like official report that shows what a company on, what it owes, and how it is performing financially. So they help you make complex number easy to understand. Now there are four main financial statement. Four main types of financial statement are there. The first is called balance sheet. So balance sheet, it shows the assets, liabilities, equities at the specific date. You can think of it as a snapshot of the company financial position. Second kind of statement we have is called income statement. So income statement shows revenue, expense, profit or loss over a period. It helps assess how the business performed. Third kind of financial statement we have is called cash flow statement. So cash flow statement track actual cash in and cash out from the operation, investment and financing. How much cash is coming in, how much cash is going out from the operation, from the investment, from the financing. That is taken care of by the cash flow statement. And finally we have the statement of change in equity. So statement of change in equity, it explains changes in the owner stake in the business, right? So as you can see, cash flow statement, I told you how much cash is coming in, how much cash is going out from operation, investment, financial activity. That is shown by the cash flow statement. And a statement of change in equity, what does it represent? It explains changes in the owner stake in the business. That means how much is the owner stake in the business is changing. So these are often explained with notes or commentary from the management. So most investors start with the income statement to check how profitable the business is during a period. So from where they start from the income statement. So the next time you look at the company financial, remember these four statements tell you the whole story, right? Now friends, let's discuss cash flow statement in more detail. Ever wondered where a company money really goes? Let's decode two powerful tools, the cash flow statement and the statement of change in equity in the simple word. First of all, cash flow statement track how cash move in, how cash move out during a specific period. Means during a specific period how cash is moving in, how cash is moving out. That is what is shown by the cash flow statement. It shows the opening cash balance, it shows the ending cash balance and how that change happened, right? So we are talking about the cash flow statement. It shows the opening cash balance, ending cash balance, how that change happened. Everything is shown by the CFS, that is the cash flow statement. So it is divided into three key parts. The first part is called operating activity, second part is called investing activity, third part is called financing activity. Operating activity include cash from daily business operation, like sale, like expenses. So whatever cash whatever is coming in or going out from the daily business operation, like sales and expense, it is covered under operating activity. Second kind of activity we have is the investing activity. So basically it includes cash which is used for buying or selling long-term asset like equipment. So suppose you are buying or you are selling long-term asset like equipment. So whatever cash is being used for this purpose goes into the investing activity. And third kind of activity we have is the financing activity, which means cash from loan, equity, repayment, interest, dividend. All these are covered under the financing activity. So three kinds of activity I told you. Operating means cash from daily business. Investing means cash used for buying and selling long-term asset. And financing means cash from loan, equity, repayment, interest, dividend. So basically, this help us understand the real cash position, not just profit, right? So I hope it is clear now what is operating, what is financing, what is investing. Now friends, there is something called a statement of change in equity. This is also called retained earning statement. It shows how owner equity changed during the period, whether due to profit, losses, dividend or new capital introduced. So a statement of change in equity shows how the owner equity changed during the period. Whether the reason may be many, due to profit, due to loss, due to dividend, due to profit, loss, dividend, new capital introduced. Because of all these reasons, that owner equity can change, right? So that is shown by the statement of change in equity. Now every financial statement comes with detailed notes. These explain the number in more detail and are crucial for proper interpretation. Now there are two common analysis methods. The first method is called horizontal analysis, which we also call trend analysis. So either you call it horizontal analysis or you call it trend analysis. What it does, it compare performance across different period. And then we have the vertical analysis. So vertical analysis look at each item as a percentage of the total in the same period. So basically, the moral of the story is that, cash flow statement tells you where the money flow. Equity tell you how the value is built, and analysis helps serve all of it. So friends, if you are looking for such kind of PDF which help you revise the entire content in a very small time, you can go for our CCP certification course, the link of which I have provided in the description section, or you can WhatsApp me on the number 8292857381. Right, I again repeat 8292857381. Right, for getting the detail regarding the PDF. Now friends, let's move forward. So we have talked about the two types of analysis we have, horizontal analysis and vertical analysis, right? So I told you in horizontal analysis, also called trend analysis, it compare performance across different period, and vertical analysis looks at each item as a percentage of the total in the same period. Now let's switch our focus to the vertical analysis. So suppose you are confused between vertical and horizontal analysis, or you are wondering about what exactly asset and liability means. Let's simplify financial statement for you. So basically, what vertical analysis does, it looks at one period and express every item as a percentage of the total. So basically what it does, it look at one period and express every item as a percentage of the total. For example, income statement item as a percentage of the gross sale, balance sheet item as a percentage of the total asset. So this is how vertical analysis looks like. Horizontal analysis compare the same item across multiple period. So basically, if you want to spot trend, horizontal analysis is the best tool you have. Why? Because it compare the same item across multiple period. And what vertical analysis do? It look at one period and express every item as a percentage of the total. Right? So remember the difference. Horizontal analysis help in trend analysis, help in spotting the trend. Like you can compare the same item across multiple period. Vertical analysis look at one period and express every item as a percentage of a total. Now let's talk about the financial ratio. Ratio help compare two financial figure to assess the performance. Suppose you have to assess the performance, and for that, you have to compare two financial figure, and that is what ratio helps in. For example, profit margin is equal to net profit divided by sales. That is one financial ratio called profit margin. How to find the profit margin? So to find the profit margin, first of all you take the net profit and you divide it by the sale. That will give you the profit margin. Now let's talk about the balance sheet basic. So balance sheet had three key parts: asset, liability and equity. What is asset? So when the company own that bring future benefit. What the company own that bring the future benefit is called asset. Second is called liability. Liability means what the company owe to the other is called liability. And third is called equity. Equity is the owner's share in the business. So I told you, the balance sheet has three key parts: asset, liability and equity. Asset means what the company own that bring future benefit. Liability means what the company owes to the other, and equity means the owner's share in the business. So remember these three things, right? Asset represent the valuable resource owned by the company, liability reflect the company obligation, and equity reflect the owner's share in the business. And remember the golden rule. The golden rule is that asset is equal to liability plus equity. So that is the golden rule. Now friends, let's understand the asset. Whenever I say asset, it means use of the fund. They usually have a debit balance and they help you earn the income. That is the meaning of asset, right? Asset is also called the use of fund. They have the debit balance and they help you earn income. They enable the business to earn income. How to categorize the asset? So at asset are categorized into current asset. Current asset means easily converted into cash, like inventory, cash receivable. These are called current asset. Assets are also includes long-term asset. So they are held for longer duration, like machinery, like land. Assets are also include tangible asset, which are the physical item. Asset also include intangible asset, like non-physical but valuable item. So whether you are analyzing the trend or breaking down balance sheet, understanding these basics give you a powerful edge in the finance. Now friends, let's switch our focus to other kinds of asset we have. So if you want to, do you want to understand how financial healthy a business is? From short-term cash flow to long-term stability, let's break down the key financial concept. What is intangible asset? Intangible asset are non-physical but valuable asset like trademark, copyright, goodwill. Right, these are intangible asset. Long-term asset include things like land, building, machinery, which are used over year in operation. These are called long-term asset. Current asset, these are short term. They are converted to cash within a year, within 12 months. For example, cash, account receivable, prepaid expense. So, cash is a kind of current asset. Prepaid expense means expense that you have already paid is a kind of current asset. Account receivable is a kind of current asset. Now, if we talk about the liabilities and honor equity, so liability are the debt that the business owe. Basically, the creditor claim on the asset. So liability has also some parts like current liability. Current liability means due within a year, like account payable, like accrued expense. So these are called current liability. So they are due within a year, right? Then we have the long term liability, which are payable after 1 year. Remember, long term liability are payable after 1 year. So two kinds of liabilities are there: current liability and long term liability. And there is a equation. The equation is that honor equity is equal to asset minus liability. Very, very important thing. One equation I told you here. What was the equation? This is a very important equation. Let me just summarize you that asset is equal to liability plus equity. So this can also be written as like honor equity is equal to asset minus liability. Right? I hope it is clear. Now friends, it is also called net worth or book value and shows what the owner truly own. What shows honor equity. Now friends, there is one more equation which says that asset is equal to liability plus honor equity. This equation, asset is equal to liability plus honor equity, shows how a business is financed through debt or through ownership. So there are some ratios which assess the bank financial strength. The first ratio is called liquidity ratio. It shows the short term strength. Then we have the current ratio. Current ratio, this is current asset divided by current liability. Then we have the quick ratio. Liquidity ratio we talked about. Current ratio, it includes current ratio like current asset upon current liability. Quick ratios, quick asset upon current liability. Net working capital, which includes current asset minus current liability. So remember, these are the important formula. I am again repeating, right? Current ratio, right? You must know what is current ratio. You must know what is quick ratio. So current ratio, remember, current asset by current liability. Quick ratio this is also called acid test ratio, which is quick asset by current liability. Net working capital, how to calculate that? Current asset minus current liability. Working capital gap, current asset minus CLOBB. What is CLOBB? Current liability other than bank borrowing. Then we have the solvency or leverage ratio. So what is included under solvency or leverage ratio? So they indicate the long-term strength. Under the solvency ratio, you have the first kind of ratio, that is debt equity ratio, tangible net worth, etc. Then we have the activity ratio. What are the activity ratio? This is stock turnover ratio, this debtor velocity ratio, creditor velocity ratio. They are called activity ratio. So broadly we can say liquidity ratio includes current ratio, quick ratio. Solvency or leverage ratio include DER, tangible net worth, and activity ratio include stock turnover. So let's continue our discussion further. Working capital, net worth, expenses type, these are confusing terms, not anymore. Let's decode them in the simple word. So what is the meaning of net working capital? It is current asset minus current liability. It shows a company's short-term liquidity. Another approach is that you compare long-term source versus long-term use to understand the owner's actual contribution. Right? Basically, net working capital shows what? Owner's actual contribution. Whenever a bank give loan, it asks the owner to contribute something, and that contribution is called net working capital. So how to get this net working capital? You subtract current asset minus current liability, or you compare long-term source versus long-term use. Then we have the working capital gap. So it is a difference between current asset and current liability excluding the bank borrowing. So this gives a clear view of the working capital need without bank support. Yes. So how much working capital you need without bank support? That is characterized by WCG, working capital gap. Now one more thing is the net worth. Net worth, how to find? So you add capital and reserve, you will get net worth. Right? You add capital to reserve, you will get net worth. Net worth just means sum of two things, capital and reserve. Net worth are of two types, tangible net worth and intangible net worth. See, tangible net worth, how to find? See, so first of all, you take the net worth and you subtract from them intangible asset. So net worth minus intangible asset, this will give you the tangible net worth. Then some ratios that you must know. First is the stock turnover ratio, which is net sale divided by stock. How to find the stock turnover ratio? In the numerator you write the net sale, in the denominator you write the stock value. So it tells us how quickly inventory is sold, right? That is called stock turnover, right? What is the net sale? How much you have sold, and in the denominator you write the stock. right? So per unit stock net sale, that is called stock turnover ratio. Second is called debtor velocity ratio. These are the very important ratio. Debtor velocity ratio show how fast you collect your receivable. You know what is the meaning of receivable? Receivable means what? Suppose you have a business and suppose you are engaged in giving out some kinds of goods. Okay, so suppose you sell some goods on credit and you have not received the payment yet. So that payment that is yet to be received is called receivable. And this receivable, how fast you receive the receivable, is shown by the debtor velocity ratio. So what is the formula for it? Quite simple. In the numerator you write the debtor. Debtor simply means the amount that is owed to you, that you will get right after a few time. So debtor you have to write, you have to multiply it with 12 and divide by net sale. This will give you the debtor velocity ratio. Then we have the creditor velocity ratio. So creditor velocity ratio measure how quickly you pay your supplier. Sometimes you also take some goods or services on credit, right? And obviously you have to pay that. So that is called creditor. In the numerator you write the creditor, multiply it by 12, divided by net sale. So this will give you the creditor velocity ratio, means how quickly you pay your supplier. So remember, these three ratios: stock turnover. In the stock turnover ratio, we divide net sale by the stock value, and the remaining these two ratios we divide debtor and creditor by the net sale, and here by purchases. Now friends, one more point is the DER, debt equity ratio. As the name suggests, in the numerator we write the total long-term debt. In the denominator we write the tangible net worth. Remember, we don't write the net worth, we write the tangible net worth, equity, right? I told you now. Basically, if we talk about the net worth, it includes capital and reserves, right? And tangible net worth includes net worth minus intangible asset. So here we are taking only tangible net worth. We are not taking intangible or net worth, right? How to find the tangible net worth? So what you need to do to find the tangible net worth, first of all, you take the net worth, and from the net worth, you subtract the intangible asset. This will give you the tangible net worth, right? So that is how we calculate the DER, debt equity ratio. So basically, sometimes some expenses are also there. Some expenses like prepaid expense. Prepaid expense, these are paid in advance for future service, like rent. You have paid the rent in advance, so it is treated as a current asset. Remember, these are the very important thing. Prepaid expense always treated as a current asset. Pre-operative expense, they are incurred before the business start operating, and the preliminary expense, they are cost during company setup. So both pre-operative and preliminary expense, they are treated as intangible asset. With these basics, you are ready to interpret financial statement like a pro, one ratio at a time, right? Now friends, let's switch our focus to, is your business financially stable in the short run? Let's decode the balance sheet and the current ratio in the easiest way possible. The balance sheet show the gross block, which means the original value of the fixed asset like the land, machinery or the building. But after subtracting depreciation, we get the net block. Obviously, you have the gross block, you subtract the depreciation, you get the net block. Net block is the actual value of the asset today, right? So that is what balance sheet shows. It shows the gross block, and after subtracting the depreciation, you get the net block. Now let's understand the current ratio. Current ratio is a major liquidity indicator. What is the formula for current ratio? Current asset by current liability. It tells whether the business can pay off its short-term obligation or not. So this current ratio tells you whether a business is capable of paying its short-term obligation or not. Now what are the current assets? So basically, these are items expected to turn into cash within a year or the business operating cycle, whichever is longer. Two things are there. Either basically these are the items which are expected to turn into cash within a year or within the operating cycle, whichever is longer. Either operating cycle is longer or within or a year is longer. Whichever is longer, turn into cash. Even if it takes over a year to convert to cash, it is still like a current asset if used in daily operation. Sometimes it takes over a year, more than a year, to convert to cash, like in long production cycle. So it's still a current asset if it is used in daily operation. Now what is current liability? I hope current asset definition are clear. Now current liability, basically this includes amount due within 12 months or the business cycle, right? Some amounts, they are due within 12 months or the business cycle. They are called current liability. Even every types of working capital loan, though sometimes sanctioned for more than a year, they are considered current liability because they are payable on demand. Remember, this is a very important thing I am telling you, that working capital loan, even though they have been sanctioned for more than a year, still they are considered current liability because they are payable on demand. Now the question is how to read the current ratio. So current ratio can be above 1, can be exactly 1 or can be less than 1. If it is above 1, so it is good, means company can meet the short term debt. If it is exactly 1, it means just enough asset to cover the liability. And if it is below 1, it means risky. You may struggle with the short-term payment. But remember, there is no fixed ideal ratio. It varies by industry, so it is best to compare with the peers. Above 1 means your company can meet the short-term debts, because current assets, so current ratio, so the current asset by current liability means obviously you have to those asset, how can you manage those assets? By having current liability. So if it is above 1, it means asset is more, current liability is less. It is a good signal, right? Then if it is exactly 1, so it means it is just enough asset to cover the liability. Yes, we have to cover the liability. We have just enough asset to cover the liability, right? And if it is below 1, it may struggle. But one more thing I want to tell you, if the current ratio is higher than 1, sometimes 1.8, 1.9, what does it indicate? It indicates that we have more inventory at our disposal. So this means this lower our efficiency, right? So gross block, net block, current ratio, each number tells a story. Know the meaning and you understand your business better. Now friends, let's switch our focus to the quick ratio. Quick ratio and cash ratio give us more accurate picture of liquidity. They exclude less liquid terms like inventory and prepaid expense. They are less liquid. So all those are excluded, showing whether the company can meet short-term debt immediately or not. So this is called quick ratio. I hope it is clear, right? So how to find the quick asset? It is nothing but current asset minus inventory or any kind of prepaid expense. You subtract this and you will get the quick asset, and divide it by the current liability. That will give you the quick ratio. Now let's talk about the activity ratio. Activity ratio measure the efficiency, which means they also call the turnover ratio or efficiency ratio. That tells us how well a company uses its asset to generate sale. Yes, see, while we're talking about the liquidity ratio, what we were more focused on, we were more concerned with whether a company is able to use its asset to generate liability. That is what we were focused on when we are talking about the asset, right? Whether the particular company is capable of converting, basically whether the company have enough asset to cover its liability or not. That we were concerned with. Now when we talk about the activity ratio, what we are concerned with, whether the company has enough asset to generate more sale, right? That is what activity ratio shows. So basically they compare sale with a specific asset like inventory, receivable, helping us see how efficiently the business run. So basically what we do in these kinds of activity ratio, we compare two things. What two things we compare? We compare, asset and sales, right? So assets like inventory we compare, receivable we compare, right, with respect to the sales. Now first of all, the first kind of ratio we have the stock turnover ratio. This is also called inventory turnover or stock velocity ratio. This ratio shows how often inventory is sold and replaced during a period, right? How often inventory is sold or replaced during a period. What is the formula for it? So it is very simple. COGS divided by average inventory. In the numerator you write the COGS, which is cost of goods sold, and divided by the average inventory, right? So this is called a stock turnover ratio. I told you basically we are comparing the sales. We are comparing the sales with respect to the asset. And what is our asset here? Our asset here is the inventory, right? So it sells as COGS upon average inventory. So what is COGS? COGS is the cost of goods sold. How to find COGS? First of all, you take the opening inventory, then you write any kind of purchase you made or any manufacturing cost you have, and you subtract the closing inventory from it. So you will get the cost of goods sold. Very simple to understand. Means whatever goods you have sold, what is the cost of that? So first of all, how much investment you have done? That is the opening inventory. Then is some kind of purchase you have made, that is also a cost that you incurred, and you have to subtract the closing balance from that. So that will give you the COGS. So that COGS has to be written in the numerator, and this COGS it's just like a sales, and in the denominator you write the inventory, which is a kind of asset. So basically average inventory, which means initial inventory plus final inventory divided by 2, right? So basically if we divide the COGS by the average inventory, this will give us the stock turnover ratio. So what does it indicate? It indicates how fast our stock is moving. Faster movement means our sales is efficient and less money locked in the inventory. It's quite simple to understand, because you look at this particular ratio. In the numerator we have COGS, in the denominator we have the inventory. So basically this ratio shows how fast our stock is moving, right? So if the stock is moving very fast, it simply means our sales is quite efficient and the less money is locked in inventory, right? So that is what it indicates. I hope it is clear now. Friends, if you really think that this video is helpful to your understanding, please hit that like button. This will motivate me to make more such and such content, right? Now friends, let's talk about the next kind of ratio. We have the inventory holding ratio. So inventory holding tell you the average time it takes to sell the inventory on hand. And this inventory holding is very critical for business managing supply chain and stock level. So better liquidity, smarter stock control, efficient asset use, that is what this ratio help you track. Master them and you master business insight. Now friends, have you ever wondered how fast a company get paid after making sales on credit? Let's decode the debtor turnover ratio in the simple term. So if we talk about the debtor turnover ratio, this is also called receivable turnover ratio. It tells us how efficiently a company collect money from its credit customer. It shows how quickly credit sales are turned into cash. So why it matters, if this ratio is higher, it means fast collection, good liquidity, efficient business. If this ratio is lower, it means slow collection, possible cash flow issue. What is the formula? How do we calculate the debtor turnover ratio? The formula is very simple. If you want to basically this account receivable ratio, the formula is net credit sale divided by the average trade receivable. Don't get confused by this term. They are very easy to understand. Net credit sale means how much sale you have. See, remember one thing, all kinds of activity ratio just deals with two things, sales and asset. Just remember it, just keep it in mind, whether it is stock turnover ratio, whether it is debtor turnover ratio, whether it is a creditor turnover ratio, no matter what, everything deals with two things, sales and asset. Now let's talk in the context of this debtor turnover ratio. What I told you, in terms of sale we have the net credit sale. Yes, some sales we have done on credit, so that we write in the numerator, that is called net credit sale. In the denominator we write average trade receivable. What we write? Average trade receivable, right? So I hope it is clear now. Now you will not forget it for the lifetime, because you have just got the crux of it. Whenever we deal with any kind of activity ratio, be it a stock, be it inventory, or be it any type, we are just dealing with sales versus asset. That's it. So in the sales, here since we are giving the sales on credit, so we have the net credit sale, and here the asset is what asset we have. The kind of asset we have is the trade receivable is the asset. In the stock inventory case, the inventory was the asset. Here trade receivable is the asset. Only the asset nature changes. That's it. So basically, what is the significance of this ratio? This ratio tells us how many times receivable were collected during a period, right? That is called debtor turnover ratio. And there is something called debtor velocity. How to find this debtor velocity? See, it is very simple. It tells you how long does it take to collect money from customer. So what you do to find the debtor turnover ratio, debtor velocity? First of all, you take the average book debt. Book debt is the same. Don't get confused by the book debt. Book debt or trade receivable both mean the same. So average book debt divided by the net sale multiplied by 365 for day or multiplied by 12 for month, that will give you the average collection period, right? Also called debtor velocity. So why it is useful? Because it helps a business to plan in cash flow, meet payment on time, avoid cash crunches. So remember these two ratios, they are super important. First of all, we talked about debtor account receivable turnover ratio. Second ratio we talked about is the now we talked about the average collection period. Now the fast collection cycle means better cash flow. So track your receivable closely. They are not just number, they are your incoming cash. Now friends, then the next kind of activity ratio we have is the creditor turnover ratio. Now friends, let's talk about the creditor turnover ratio. So basically, if you want to know how fast a company pays its supplier and what it say about its credit worthiness, let's simplify the creditor turnover ratio. So it is also called account payable turnover. So this ratio shows how quickly a business pay off its supplier. So it is a key sign of the company's payment discipline and credibility. If this ratio is higher, it means fast payment to supplier, it means good credit worthiness. And if this ratio is lower, it means if the credit turnover ratio is lower, it means delayed payment, it means possible cash flow issue. But remember, this depends on the credit term. If supplier give long payment period, this ratio may naturally be lower. So pay your supplier on time, but also utilize the full credit period offered. This helps with the better cash flow management, right? So what is the formula for credit turnover ratio? So in the numerator you write the credit purchase, in the denominator you write the average account payable. So this shows how many times you clear your payable during a year, right? That is how to show. Now there is something called average payment period or creditor velocity. See, it shows how long on average does a company takes to pay its supplier. So what is the formula for average payment for this, average payment period or creditor velocity? So you write average creditor divided by purchase multiplied by 365 per days, or 12 months, 12 divided multiplied by 12 for months, right? So average creditor divided by purchase multiplied by 365 for days, or 12 for month. There is something called trend analysis. Is that if the creditor turnover ratio decreasing ratio, it means you are delaying payment more than before, and if the ratio is increasing, it means you are setting your dues faster. So paying supplier on time builds trust, keep operation smooth. Track this ratio to keep your credit reputation strong. Now friends, let's have a look at the next ratio. Ever wondered how money flow in business from buying goods to receiving payment? Let's break down working capital and the operating cycle in a plain English. So first of all, gross working capital refers to the total investment in the current asset like cash, stock, receivable, etc. So what is your total investment in the current asset? That is shown by the gross working capital, right? I hope it is clear. Total investment made in the current asset is called gross working capital. Then we have the net working capital. It shows how much of the current asset are funded by the long-term source. Yes, total investment in the current asset means gross working capital. But out of the total investment which we are doing in the current asset, how much is funded by the long-term investment, long-term source? Basically, the owners or promoter investment in day-to-day operation is what is called by the net working capital. It is also called the surplus of the long-term fund over long-term use, which act as a cushion to fund the working capital need. Yes, so you have to fund your working capital need. Working capital is a kind of asset, right? So to fund those working capital need, you require some long-term source like promoter security, right? So these things, this particular thing is shown by the net working capital. Means you have to put money into the current asset, right? So current asset has to be funded. But what is the source of those funding? The source of those funding is long-term source like promoters or owners investment, right? So total investment in the current asset, that is gross working capital, but the total investment in the current asset made from the long-term fund or long-term source, that is the net working capital. So, and then we have the working capital gap. So which is, this gap reveals the part of the asset that must be financed by the business itself or other long-term source, right? So those part of the asset which has to be financed by the business itself or other long-term source, that is called working capital gap. So how to find the WCG? Current asset minus current liability excluding the bond gap reveals the part of the asset that must be financed by the business itself or other long-term source, that is called working capital gap. Now let's talk about the operating cycle. So operating cycle is the full circle, right? So operating cycle, it is a full circle which of how working capital flow through the business. So what are the parts of it? I told you that it includes buy raw material, produce goods, sell finished product, collect cash from customer and pay to supplier. So this is how the working capital cycle looks like. So for trading business, as you can see, working capital cycle, again I'm repeating: buy raw material, produce goods, sell finished product, collect cash from customer and pay to customer. For trading business, the cycle starts from buying inventory to selling it and collecting money. For manufacturing, it includes raw material purchase, then production, then sales and then collection. Now there is something called red flag. Red flag is that a rising account payable turnover ratio may looks good, but if it is too high, it might mean company is not investing enough back into the business. So understanding working capital and the operating cycle is the key to manage the cash flow. Now let's look at the profit and loss statement. If you want to know if a business is actually making money, let's break down the profit and loss statement step by step. What is this PL&A statement? It is also called income statement or statement of operation. It shows a company revenue and expense over a specific period, like a quarter or a year, right? So how much is the company revenue, how much is the company expense over a specific period is shown by the profit and loss statement, right? So it tells us how will the company generate profit, through higher sale, lower cost, or through both. So how will a company generating the profit? Either through higher sale or through lower cost or both. Obviously if sale is higher, then profit will be higher. Cost is lower, profit will be higher, or both will be done. Obviously the profit will be higher. There is something called revenue. Revenue is the money earned from selling goods and services after returns and discounts. And the cost of goods sold, that is COGS, is means all direct costs tied to making or buying a product. All kinds of direct cost which is connected or which is tied to making or buying a product is called COGS, like raw material, labor and shipping. How to find the gross profit? See, gross profit is the subtraction between, if you subtract the COGS from the revenue, you will get the gross profit. So you take the COGS, means all the direct cost, and you subtract the revenue, you take the revenue, you subtract the COGS, that you will get the gross profit. Simple formula. You know the profit formula, sales minus cost. So your revenue is the total sales, COGS is the cost, subtract both of them, you will get the gross profit. Then we have the operating expense. So these are the indirect costs needed to run the business. So it includes some selling expense. What is selling expense? Like, advertisement, commission, shopping. It includes some administrative expense, like, office, salary, rent, insurance. So these are some of the indirect costs needed to run the business. Then we have the operating income. Operating income after subtracting, see, first of all, we have the gross, sale, right? So we have the revenue. From revenue, we subtract the COGS, we get the gross profit, right? Then we have some indirect costs needed to run the business, like selling expense, administrative expense. After subtracting the operating expense from the gross profit, we get the operating income. So from gross profit, if we subtract the operating expense, we get the operating income. So this is a cycle, right? First of all, you take revenue, subtract COGS, you get gross profit. From gross profit, we subtract the operating expense. You will get the operating income, which is the company core profit from running the business, right? So the P&L statement, that is profit and loss statement, is like a report card of a business. It shows what comes in, what went out, what is left. Master it, and you will understand the heart of any business. Now friends, there are some more important points. So first of all, we have other income and expense. So this include things like dividend, interest earned, interest paid, gain, losses from the financial asset. They are not part of day-to-day operation, but still impact the bottom line. So first of all, income before tax. How to find the income before tax? You write the operating income, you add other income, and you subtract any other expense. That will give you income before tax. You have not paid tax yet, however, whatever income you have. So operating income plus other income minus other expense. This give you the PBT, right? Profit before tax, income before tax, PBT. How to find PBT? Operating income plus other income, subtract expense. This will give you PBT. Now comes the star of the show, which we call net income or net profit. So this is what the company truly earned after all cost, all taxes, all expenses are subtracted. It is the final profit. So to evaluate performance, we also have, some kind of ratios called profit ratio. This question is asked, what is the gross profit ratio? How to basically gross profit ratio, to calculate it, gross profit by net sale multiplied by 100. It shows how efficiently the business is managing production cost, right? How efficiently the business is managing the production cost is shown by the GP ratio. A higher GP ratio means either higher selling price or reduced production cost. See, the ratio is quite simple. In the numerator we write the profit, in the denominator we write the sale, multiplied by 100. So if the ratio is higher, it means selling price is higher or production cost is lower. Both are the good sign, right? If the GP ratio is higher, it simply means the selling price is higher or production cost is lower. Both are the good sign. But if the product price drop, input cost rise, or the operation slow down, so the GP ratio will fall down. So that is what is indicated by the GP ratio, how efficiently the business is managing the production cost. Then we have the net profit ratio. Net profit upon net sales multiplied by 100. It tells us how much real profit the company is making from its sale. Higher net profit ratio means lower overall cost, means better financial strength. So remember, net sale is equal to cash sale plus credit sale minus sales return. Net profit is equal to revenue minus all direct and indirect expense. So these ratios, if you track over the time, they help you analyze the performance and spot any kind of trend. Now friends, if you have a low, so I told you now that let's quickly decode some key financial concept. First of all, we have the net profit. Suppose your net profit is low, it means that your direct or indirect costs are too high, eating your profit, right? If your net profit is low, it means your direct and indirect costs are too high, so it will eat your profit. Then we have the operating income, right? So net profit, we have talked about operating income. This is what you get after subtracting operating expense. So after you subtract your operating expense like wages, rent, utilities, logistic. So after you subtract these kinds of operating expense from the gross profit, what you get is the operating income. So how to calculate the net profit? From operating income, when you subtract interest and tax, you get the net profit, which is the company final earning, right? So how to find the net profit? Very simple. First of all, you take the operating income. From operating income, you subtract any kind of tax you have paid, any kind of interest you have paid, and you will get the net profit, right? And how to get the operating income, right? I told you very easily. Now the next point is profit and loss management. Managing the profit and loss statement means keeping a close eye on both the income and the cost to boost your profitability. right? So from gross profit, if you subtract operating expense, you will get operating income, and from operating income, if you subtract the any tax you have paid, any interest you have paid, you will get the net profit. So remember the sequence, right? Now friend, there is something called net DSCR. DSCR is called debt service coverage ratio. So basically this tells you if the business can pay debt using its cash flow or not. So what is the formula for DSCR? In the numerator we write the net cash inflow, and in the denominator we write the total amount of obligations we have, loans we have, means interest and principal we are paying, right? So revenue divided by debt service, that's it. Revenue divided by debt service means how much cash flow inflow we are generating and how much is our debt service. We combine, we compare both of them, we will get net DSCR. Remember, if it is more than 1, you are safe. If it is less than 1, your repayment is in trouble, right? You have the repayment trouble, remember it. Now let's talk about the gross DSCR. What happened in the gross DSCR? You subtract operating expense from the revenue and divide by the debt service. See, in the net DSCR, what we were doing, we were just writing the revenue in the numerator, and in the denominator, what we are writing? In the numerator, we are writing the revenue. In the denominator, we are writing the how much expense we have, right? How much debt service we have. That will give us net DSCR. If it is more than 1, you are safe, means you have enough revenue to cover your debt service. If it is less than 1, if you are unsafe. Now let's talk about the gross DSCR. When we talk about the gross DSCR, what we do, we subtract operating expense from revenue and then divide by the debt service. That's the difference. See, in the net DSCR, we just write the revenue in the numerator. In the gross DSCR, we subtract the operating expense from revenue, right? So basically, gross DSCR include non-cash expense like depreciation also, right? So it shows the potential to repay, while net DSCR shows the actual repayment capability. So remember, if gross DSCR is high but net DSCR is low, it means non-operating or non-cash costs are draining the real cash. So two kinds of DSCR we have: gross DSCR, where we subtract operating expense from revenue and then divide by the debt service. It shows the potential to repay, while net DSCR shows the actual repayment capacity, right? So suppose gross DSCR is high, net DSCR is low. It means non-operating cash or non-cash costs are draining the real cash. Let's do the fund flow analysis now. So we have talked about the cash flow statement, we have talked about the balance sheet, we have talked about the PL&A account. Till now we are talking about the same. Now let's switch our focus to the fund flow analysis. So it helps you see where the funds are coming from, where they are going, connecting the short-term and the long-term financing. So remember, track cost, manage cash wisely, and monitor DSCR to maintain the financial strength. So what is the fund flow basic? It compares two balance sheet to track where the fund came from, like new loan, capital, and where they are used, like buying the asset. Now try to understand. If the liabilities goes up, that is a source of fund. If the asset goes up, that is a use of fund. If liability fall, that is a use of fund. If asset fall, fund get freed up. Remember it, right? So liabilities goes up, asset goes up. So friends, if we talk about the fund flow basic, you know it very well. If liability goes up, that is a source of fund. If the asset goes up, that is a use of fund. So using long-term fund for short-term need is okay, but using short-term fund for long-term asset, that is risky. It can reduce liability, it can reduce liquidity, and it can reduce the current ratio. This is called diversion of fund. What is diversion of fund? Suppose you are using long-term fund for short-term need. It is okay, you can use long-term fund for short-term need. That is what NWC is all about. But you are using short-term fund for long-term asset. You are using short-term fund for long-term asset, right? So that is risky. You can't use short-term fund for long-term asset, right? So it can reduce liquidity ratio and it can reduce the current ratio, right? So this is called, what happened, that when term loan installment are paid, the outstanding loan balance reduces and fixed asset reduce in value over the time due to depreciation, right? So that is what I'm talking about. When term loan installment are paid, outstanding loan balance comes down and fixed asset reduce in value over the time due to depreciation. On the flip side, retained profit increases reserve balance. So that is term loan and depreciation. Now friends, if you compare fund flow and cash flow statement, so fund flow statement work on accrual basis. Very, very important part I'm telling you, right? Remember, this fund flow statement, it work on accrual basis, right? That means they show the real movement of the fund. But cash flow statement work on the cash basis, means they record actually the actual cash transaction only. You know the meaning of accrual basis and cash basis? It is very simple. For example, depreciation or revaluation, no real cash flow is there, so it won't show in the cash flow, right? So fund flow statement work on the accrual basis, means it is recorded only when it is accrued, right? So it and sorry, that is cash flow basis, right? So they show the real, yeah, they will show the real movement of fund, that fund coming in, fund going out, that is the fund flow statement. But the cash flow statement work on the cash basis. They record actual transaction happen. Suppose, for example, let me give you one example, like depreciation. So depreciation, you can't show the depreciation, right? You can just anticipate that this particular machine is going to have wear and tear in the next 4 months or 4 years. So that is called accrual basis. No real cash flow is there in the case of depreciation. So it will never be shown in the cash flow. It will be shown in the fund flow statement, which is so very very important point. Remember this thing, right? Now friends, some terms you must know, that fund flow statement is also called source and application of fund, movement of fund statement, where fund come from and where the fund went. Then we have the next point, that is called ROE, return on equity. To compute the return on equity, we write the net profit and we compare the net profit with respect to the T&W. What is T&W? Tangible net worth, and we multiply it by 100. So it shows how efficiently profit is generated using the shareholder money. So we are talking about ROE. ROE means return on equity. In the numerator of the ROE we write the net profit. In the denominator we write the tangible net worth multiplied by 100. That will give you ROE. It shows how efficiently profit is generated using the shareholder money. We have the shareholder money, how efficiently we are able to generate the profit. That is what is shown by ROE. Then we have the ROI. What is ROI or ROCE? So this is basically we compare net profit with respect to the total investment. This shows return compared to the total capital invested. That is called ROI. So return on equity means equity, right? Shareholder money, that is equity. That is called tangible net worth. So remember, tangible net worth is the same, right? There are some net worth which are intangible. Can you give me some example of intangible net worth? Please type in the comment section. So there are some net worth which are intangible, but there are some net worth which are tangible, which are actual shareholder money. So when we compare profit with respect to the tangible net worth, this is called ROE. And if we compare profit with respect to the total investment, this is called ROI, or we call it ROCE. So now let's talk about this ROI and ROE in detail. So friends, return on investment and return on equity both measure the performance, but ROI include debt, while ROE looks at only shareholder equity. A company can have high ROE but low ROI, or vice versa, depending on how much debt is involved. I hope it is clear. ROI versus ROE, what does it mean? Now there is something called operating profit ratio. So this ratio shows how efficient a company is in its core operation. So how to calculate this operating profit? Very simple. In the numerator you write the operating profit, in the denominator you write the net sale multiplied by 100. That will give you the operating profit ratio. So higher the operating profit ratio, the better the operational efficiency. Very simple. The third ratio we have is called FACR, or fixed asset coverage ratio. It checks whether fixed asset can cover long-term debt or not. How to calculate FACR? In the numerator you write the net fixed asset, in the denominator you write the secured long-term debt. Divide both of them. This will give you fixed asset coverage ratio. Remember, there is a benchmark of 1.33:1. It means asset should be at least 1.33 times the loan. Because when we say FACR, in the numerator we are writing net fixed asset, in the denominator we are writing the debt. So that is what we are comparing, fixed asset versus the secured long-term debt. Then we have LLR. LLR is called loan life coverage ratio. This is also called loan life ratio. It is similar to DSCR, but it is used in project finance. I told you DSCR what it was all about. Remember it? In the denominator we write the debt coverage, in the numerator we write the revenue. Similarly, this LLR is similar to DSCR, but it focuses on project finance. While DSCR focus on a specific time, LLR look at the entire loan tenure to see if the debt can be covered over the long run. Right, that is the difference. Now let's talk about financial and non-financial risk. So financial risk come from market activity, which includes market risk, right? Which includes market risk like due to the change in the interest rate, stock price, exchange rate, market risk can arise. Currency risk is there, which affect global business as currency value change. Credit risk is there, which indicates the danger of default or counterparty failure. Liquidity risk is there, when selling an asset quickly leads to sharp loss. Settlement risk is there, where delays or failure in the transaction payment. Legal risk is there, which means lawsuit or contract breach by other party. So these are the financial risk. On the other hand, we have some kind of non-financial risk which come from external factor like regulation, environmental change, supplier issue, etc. etc. Now friends, do you know what really put your business at risk? It is not just market crash or interest rate hike. It is the risk you might not even see coming. So first of all, let's break down the compliance risk. Right, it is the risk of facing penalties, extra taxes, have to redo your account if the law or the tax rule get changed. Next, we have the model risk. This happens when the financial model give wrong value because of the flawed assumption. We have assumed flawed, because of which our model give the wrong result. Then we have the tail risk. So tail risk, you can think of rare extreme event like the 2008 crash. These don't happen often, but when they do, the impact is massive. Then we have the operational risk. It's all about things going wrong inside the company, bad system, error by staff, poor process. It's all included in the operating risk. Solvency risk means your company might run out of cash and be forced to sell asset at a bad price. Let's talk about the non-financial risk. So these are the risks from things outside the financial world, like new regulation, climate event, even supplier issue. Every risk, whether financial or non-financial, it has three parts: the cause, the event, and the impact. They are the three parts of every risk: cause, event, and impact. And remember, almost all risk eventually hit your bottom line. So financial risks like market risk, credit risk, liquidity risk, they are usually managed by the finance team. But non-financial risks like operational failure, poor strategy, they are harder to measure and often handled by different departments. These risks are also hard to control because there is a limited data. They depend on people across the company. There is not just a single risk team. Lastly, don't ignore the big picture. There are some big picture. So, there are some macroeconomic factors like inflation, GDP, unemployment. They can seriously shake up your risk landscape. So these are most out of control, driven by government or global event. That is why non-financial risks need as much attention as financial one. Then we have the net present value. Let's discuss in detail. So want to master capital budgeting in just few minutes? Let's break down the most important tool, that is called NPV, IRR, and payback period break-even point. What is NPV? So NPV help us judge if the project is worth it or not. We calculate the present value of the future cash inflow. We calculate the present value of the future cash inflow and then subtract the initial investment from it. That will give us NPV. Now two things are possible. NPV can be positive or NPV can be negative. If NPV is positive, go for it. If NPV is negative, reject it. Remember, all among project, the one with the highest NPV wins. Second kind of investment measuring tools we have is IRR, that is called internal rate of return. It is the rate at which the NPV becomes zero. In simple word, it is the return that a project generates internally. If IRR is higher than the required return, it is a good investment. But IRR ignore things like inflation or market trend. It is purely internal. Right. So what I am telling you, that IRR is the rate at which NPV becomes zero. In simple word, it is the return that a project generates internally. If IRR is higher than the required return, it is a good investment. But IRR generally ignores things like inflation. Then the next tool we have is the payback period. What is payback period? This tells you how long it takes to recover your investment. For example, suppose you spend 1 lakh and recover in 3 years, so your payback period is 3 years, right? So shorter payback period means less risk. That is what the meaning of payback period. It compares investment project by calculating how many years it takes to recover the initial outlay. If the payback period is shorter, it means you have the less risk. Then we have the break-even point. So it means no profit, no loss. It is when your sale cover all the cost, right? No profit, no loss. Basically, it is when your sale cover all the cost. What is the formula for break-even point? Fixed cost divided by selling price minus variable cost. Then we have the margin of safety. This shows how much cushion you have before the loss start. Higher the margin, safer your business. It tells you how much sale can fall before you start making loss. Then we have the ROC, which is the return on capital employed. It shows how efficiently you are using your capital. Formula is net operating profit multiplied by 100 divided by capital employed. So if the ROC is higher, it means performance is better. Then we have the capital employed. It is the total long-term money used in the business. Equity plus reserve plus long-term loan minus current liability will give you the capital employed. Then we have the ROA, which is return on the asset. It shows how much profit you earn from every rupee of the asset. Right, how much profit you earn from the every rupee of your asset. Formula is net profit by total asset. Return on total asset, very easy to understand. Right, so NPV, IRR, payback, break even all help in choosing the right project. So we are dealing with ROA right now. So ROA tells us how efficiently a company is using its total asset to earn profit. Then ROI. ROI is the return on investment, which is called earning power ratio. It compares the return earned from an investment to its cost, expressed at percentage. It also includes some negative return. It gives us a full picture of the performance. Then we have the PERT and CPM. So basically these are the project planning tool. They help manager plan, schedule and control the project effectively. Both use network diagram to show the order and dependency of the project activity. So they focus on two things. The first thing they focus on is the event, which means which mark achievement needing no resource. Then second thing they focus on the activities, which is the real task that take time and resource between event. Event which mark achievement. So event require no resource, whereas activity which is the real task that take time and resource between events. Now if we move to the credit analyst, which is the core part of the financial risk assessment. Credit analysts review financial statement and assess loan request, new, modified or refinanced. They present their finding to the management, especially about the repayment capacity, always following the latest lending rule. A strong credit score make it easier to get loan and better terms. India follow a 300 to 900 score system. A score above 750 is usually needed for loan approval. RBI recognize 4 credit bureau. What are the 4 credit bureau? Experian, Equifax, Civil and CRIF Highmark. These bureau collect and share borrower data with bank to assign a score. Credit score usually uses a statistical model to judge a borrower creditworthiness. Right. Now friends, let's talk in detail about this credit scoring model. Ever wondered how your credit score affect your loan or what commercial paper really means? Let's understand. Credit scoring tells the lender how likely you are to repay your loan or how likely you are to repay your default. In India, its score can range from 300 to 900. A score of 750 plus is considered excellent. This means lower interest rate and higher chance of loan approval. So what are the key factors that affect your score? Let's look at it. First of all, payment history. Even if you missed one payment, it can drop your score by 100 plus point. Credit utilization ratio, that is called CUR. So using too much of your available credit lower your risk score. Credit mix, which means a mix of secure like home loan and unsecured like credit card loan, it is better, right? So secure and unsecure mixture is better. Hard inquiry, too many loan application can signal credit hungry behavior. So this can affect your credit rating. Then we have the commercial paper. What is commercial paper? It is a short-term loan instrument used by big company to raise quick money, like for salary or for bill. It is unsecured instrument, meaning there is no collateral involved. Only the company promised to repay. It is sold at a discount. CP offer lower return than bond. Commercial paper offer lower return as compared to the bond, but they are popular due to their short duration. Very short duration they have. Right, company can raise the quick money, but the return they offer is lower than the bond. So longer CP terms means higher interest cost, but still cheaper than the bank loan. Obviously, right. In India, RBI introduced CP in the year 1989 based on the Vagul Committee recommendation. Remember the name? Vagul Committee. So to issue a CP, a company must have 5 crore net worth at least, good dividend paying history. RBI regulates CP volume every year. Minimum issue 1 crore, minimum lot is 5 lakh, right? So individual lot should not be less than 5 lakh and minimum issue is 1 crore. And remember, CP are not treated as unsecured bank advance, they are regulated separately. So whether you are maintaining a healthy credit score or understanding how big firm raise fast cash, these concepts are key to mastering the financial literacy. Again, I am telling you, if you are looking for any kind of courses on CCP, please WhatsApp me on the number shown in the description section, or you can see the course link directly in the description section. Friends, commercial paper is a short-term debt instrument used by company. Net worth must be 5 crore. DER should not exceed 1.05. Debt servicing ratio should be close to 2. Current ratio should be 1.33 or more. And the company must be listed on the stock exchange. Now, commercial paper can be issued in two ways. Either at a discount to its face value or with an interest component. And here is a bonus. There is no stamp duty on issuing or transferring the commercial paper. Now let's talk about the letter of credit. It is a guarantee from a bank. It promises that the seller will get paid if they meet the term which is set by the buyer. Let's simplify it further. It's like the bank is saying, seller, if you do your job, I will make sure that you will get paid. Now there are different types of LC. Let's understand the term one by one. The first is called inland LC, which is used for domestic transaction within the same country. Then we have the documentary LC. So what is documentary LC? The seller must submit the documents of title and other paper to get payment. Then we have the clean LC. Clean LC, no documents of title is required in the case of clean LC. So LC follow UCP 600 rule internationally. There are 39 standard rules set by the ICC. So what are the common documents which are required? Which includes invoices, railway receipt, lorry receipt, bill of lading, way bill, draft, etc. Now types of LC. Irrevocable LC, which means once issued, it cannot be cancelled, it cannot be changed unless everyone agree. Revocable LC, which means it can be modified or cancelable anytime by the issuing bank. Revolving LC, it is called reusable LC, reusable credit. Once used and repaid, it get automatically refilled, saving the effort of issuing new LC each time. Confirmed irrevocable LC. What is confirmed irrevocable LC? Here a second bank apart from the issuing bank guarantee the payment, giving extra safety to the seller. Then we have the transferable LC. So it allows the original seller, who is the beneficiary, to transfer part or full value of the LC to another seller. That is why it is called transferable. It allows the original seller to transfer the part or the full value of the LC to the another seller. Right. So these are the different kinds of LC we have. Then we have back-to-back LC. So basically imagine you are a middleman, not the manufacturer. You receive an LC from a buyer and you use the same LC to open another one in the favor of your supplier. That is back-to-back LC. Leveraging one LC to support another. Smart but needs control. Deferred payment credit. This is called Ujans LC. Payment is not immediate. No drafts are allowed. LC clearly mentioned when the payment will happen in the future. It's all about agreed date. Acceptance credit. Similar to deferred, but here the beneficiary must draw a Ujans draft. The designated bank accept it and pay on the maturity date. Drawing the draft is mandatory here. One thing is caution that banks should avoid LC that have a without recourse clause. Why? Because it means additional risk. Bank could end up liable beyond the LC amount. Risky business. Who are the key parties in a letter of credit? Applicant means the buyer requesting the LC. Issuing bank, which means the bank that issues the LC. Beneficiary means the seller receiving payment. Advising bank means communicate LC detail to the beneficiary. Negotiating bank, who pays after verifying document. Reimbursing bank, who handle the actual payment to the negotiating bank. Again I am repeating. Applicant is the buyer requesting the LC. Issuing bank is the bank that issues the LC. Beneficiary is the seller receiving the payment. Advising bank communicate LC detail to the beneficiary. Negotiating bank pays after verifying document. So what are the do's and don'ts for bank? Issue LC only for credit-worthy beneficiary. Get a status report not older than 1 year. Don't issue LC based on guarantee from another bank. Don't provide guarantee for LC opened by another bank. What are the LC documentation rule? So basically, original LC must carry a revenue stamp. It should be sent through the negotiating branch. Changes to irrevocable LC are valid only if accepted by the beneficiary. So remember, draft must be drawn on the bank, not the applicant. That is UCP 600 Article 6 says the same. Draft, any kind of draft must be drawn on the bank, not on the beneficiary, not on the applicant. Expired LC can't be extended unless requested by the opener. After 3 weeks of expiry, bank should reverse the LC liability. For revolving LC, what happened for revolving LC? New funds are allowed only after the previous bill are paid. Right. Now friends, let's talk about some more important point regarding the charges. Yes, very important aspect. So we will break down the concept of bank guarantee, contingent liability, and terms like EMD, security deposit, etc. Suppose a bank account has insufficient balance and a bill is charged to it. It does not count as a real payment, right? So the liability is still active, so it is called contingent liability and it stays until the actual settlement. So what I am telling you, that suppose a bank account has insufficient balance and a bill is charged to it, it does not count as a real payment. Rather, the liability is active. It is called, contingent liability. Now, what is a bank guarantee? Under the section 126 of the Indian Contract Act, a guarantee is a promise to fulfill someone else's obligation if they default. Remember this section? What is a guarantee? It is a promise. What kind of promise? To fulfill someone else's obligation. If someone default to fulfill their obligation, this is called, basically guarantee. A contract promising to fulfill a third party obligation if they default. So basically a bank guarantee is this promise made by the bank, assuring the creditor that if the customer fail, the bank will pay. Who are the three parties in a guarantee? The guarantor, which is the bank, the principal debtor, which is the bank customer, the beneficiary, who is the creditor. So there are three parties involved in the guarantee. Who is the first one? Guarantor. Guarantor is the bank. Principal debtor is the bank customer. Beneficiary is the creditor. So the main duty lies with the customer. The bank steps in only if the customer fail. Who has the main duty? The guarantor has the main duty, right? Now friends, is the money given immediately? No. When a guarantee is issued, the bank don't pay any money unless the guarantee is invoked. So this is called non-fund based facility. There is no cash outflow at the time of issuing. That's why it is called non-fund based facility. What is the impact on bank ratio? So since there is no actual money involving during the issue, this does not impact the credit deposit ratio. Credit deposit ratio remain intact. Bank usually collect fee upfront and it is recorded as income whether the guarantee is used later or not. Now there is something called PG. PG is called performance guarantee. It covers only monetary loss. If the contractor failed to meet obligation, it covers only monetary loss. It does not guarantee actual work performance. If we compare EMD and security deposit, so contractor may give a bank guarantee instead of EMD or security deposit when bidding for tender. What is EMD? Earnest money deposit. It is refundable. It is generally under 5% of the tender value. And if the bidder back out after winning, EMD can be forfeited. So 5% of the tender value has to be submitted in the form of EMD. And if the bidder back out after winning, so EMD can be forfeited. Security deposit is collected from winning bidder to cover any loss if the contractor failed. So EMD and security deposit. To summarize, bank guarantee are non-fund based commitment. They help ensure contract performance. No money flow out unless the guarantee is called upon. EMD and security deposit help prevent tender misuse and protect the buyer. Then let's talk more about the DPG, security deposit, etc. So we are talking about the security deposit. Security deposit, after winning a bid, bidder must deposit security. This can be cash, this can be BG, this can be NSC, National Savings Certificate. So their EMD or earnest money deposit is refunded only after the security deposit is accepted. Right? Earnest money deposit is refunded after the security deposit they have deposited. Then we have the DPG, which is called deferred payment guarantee. It is a non-fund based facility commonly used for buying machinery. The bank promised to pay the installment to the supplier if the buyer fails to do so. Suppose buyer did not pay. So the bank promised that yes, I will pay to the supplier. That is called DPG. So banks are usually cautious while giving DPG to new business. Then we have advance payment guarantee. So if the principal give money in advance to the contractor, the guarantee ensures that money is repaid if the contract terms are not made. What are the restrictions on guarantee? Bank cannot issue guarantee for company raising money via NCD. So suppose some company is raising money via non-convertible debenture. In that case, bank cannot issue guarantee. And bank also cannot guarantee intercompany loan, NBFC repayments to or support deposit with non-banking firm. What are the types of guarantee we have? The first type we have is a secured guarantee. What is secured guarantee? It is fully backed by the asset or government guarantee. Then we have unsecured guarantee. If the recoverable value is less than 10% of the guarantee amount, it is called unsecured guarantee. Then we have the conditional guarantee. It can be invoked only if a specific condition are fulfilled. Then we have the unconditional guarantee, which means it can be claimed anytime within its validity period. So if we want to assess a DPG, suppose if we want to assess a DPG, that is called the deferred payment guarantee. How to assess it? So you should check the DER, you should check the margin, and you should check the DSCR. So all of these checking, right? Then you can assess the DPG. Now some more points regarding BG you must know. Bank guarantee are very powerful tool in banking, but if not handled correctly, they can become risky. So first of all, we have something called protective clause must. Every bank guarantee must clearly mention the guaranteed amount and the valid claim period. No open-ended liability should be there. Then they have the dual signature. Remember, as per RBI, any BG above 50,000 must be signed by two authorized officials. You should use only a standard format. BG should use the bank standard format. Any change in it need approval from the higher authority. Avoid onerous clause. Do not include clauses that are vague, that are difficult, that are legally risky. Do not include such kind of clauses. Next point is separate claim period, which means the claim period is a separate window, maximum 6 months, for submitting claim after the BG expire. It is not part of the validity period. Then we talk about the limitation period, which means what is the meaning of limitation period? Limitation period, for government guarantee, the claim limit is 30 years, and for other only 3 years is that. Advance payment guarantee. In the case of APG, good must be placed or hypothecated like in the fund-based limit. So APG, they are treated like performance guarantee. Items under APG should reduce the drawing power. Now friends, company charge. If a joint stock company take APG, the charge must be registered under the section 125 of the Companies Act. Suppose partial work is done, which means bank liability won't reduce for incomplete work unless the beneficiary give written confirmation. Now, before contract guarantee, ensure that client has technical skill, experience and resources to complete the work. Now, what about the interest in the guarantee? If interest is included, it need explicit approval. It must mention clear amount, clear rate, clear time period. And bank liability has two parts, principal plus interest. Right? Remember it. And avoid auto renewal clause. They are treated as onerous and must be avoided. Auto renewal clause. Now friends, let's talk about something more about guarantee. So some guarantee have self-renewable clauses, which means they renew automatically at the beneficiary request, even without the borrower consent. That is risky for the bank. So this should be avoided. Onerous clause means high obligation. If the clause make the bank responsibility uncertain or excessive, it is called onerous clause. Such clauses should only be included after approval from the competent authority. Then arbitration clause. So while issuing guarantee to the government department or PSU, you usually don't need an arbitration clause unless the beneficiary specifically asks for it. What is the meaning of arbitration clause? It means any dispute will be settled by the arbitration, not in the court. It is also called Scott versus Avery clause. Then we have dispute settlement. Let's understand how disputes are settled on the amount involved. Up to 50,000 handled by RBI. Up to 5 lakh need CMD approval. Above 5 lakh need board approval plus government appointed arbitrator approval. Then if we talk about the jurisdiction clauses, so where disputes are settled, so these specify the location where legal disputes should be handled. Right? So remember, these are the very, very important aspects we are talking about. Now friends, let's talk about more. Let's understand the key rule about the bank guarantee. So there is something called, a standard banking practice. So what happened, that bank must follow uniform guarantee practice, which is recommended by the high level committee led by the Sri A. Ghosh. So there is a high level committee led by the Sri A. Ghosh, and he recommended, a standard banking practice. This ensures safety and consistency. Now central government guarantee. So if a guarantee is for central government department, it should be formally addressed to the President of India. But any communication should go to the actual beneficiary official who accepted the guarantee. If it is a state government guarantee, you should address to the governor of the state. Always mention the exact department, beneficiary name and the purpose in your documentation. Now there is something called, prompt payment on invocation. Whenever a guarantee is invoked, bank must make payment immediately. No legal opinion, no delay, no higher approval. Delay can cause damaged trust in the banking system, especially while dealing with the government body. Now, what is the impact on delay? If the bank delay payment, it can harm the bank reputation. It affects the government revenue collection. It creates suspicion of collusion between the bank and the customer. Now, let's talk about the extension of guarantee. Bank can extend the guarantee period if the customer requests for it, but the original terms and conditions must remain the same. So to summarize, following proper guideline, ensure trust, smooth operation and protect the credibility of the bank when dealing with this kind of guarantee. Now friends, there are some more points. Let's have a look. Renewal request. Customer must request renewal before the guarantee expire. Once it expires, renewal become tricky and may not hold legal value. Now post-expiry renewal. If the beneficiary insists on renewal after expiry, the bank should issue a new guarantee with a clear start date and the old one must be formally closed. Now let's look at how guarantee is monitored. For guarantee worth 5 lakh or more and valid for over 6 months, bank must review them every 6 months starting from the first 6 months. Then we have the expired guarantee. If there is no pending claim, expired guarantee must be reversed from the book to avoid hurting capital adequacy. What is the meaning of protective clause? IBA advised bank to follow a standard format with protective clause in guarantee. Suppose a guarantee does not have this clause, reversal should only happen after getting the original document back or no claim letter from the beneficiary. There is something called judicial guarantee, which means guarantee issued during court cases remain valid until the case is over. Now some more points, have a look. So friends, if the claim under a bank guarantee is under court scrutiny, the bank must wait for the final court order before making any payment. And if the bank is involved in the case and the court rule in the favor of the government, no certified copy is required. But if the bank is not a party, it needs an attested court order or minute to proceed until the plan appeal. Now how to compare the guarantee and letter of credit? Let's see. So letter of credit, common in the international trade, payment assurance across country. However, BG, they are often used in real estate or infrastructure project within the country. So LC are short term, around 90 days, while standby LC, which is called SLBC, they are long term, typically 1 year. if you look at the legal standards, so regular guarantee are governed by the mutually agreed law. Remember, regular guarantee are governed by the mutually agreed law unless they follow URDG 758, right? As SBLC, a standby letter of credit follow international norm like UCP, ISP 98, right? So as SBLC in India, Indian bank are only allowed to issue commercial SBLC for import, not financial SBLC. There is something called, bill co-acceptance. It is the bank promise to pay the seller if the buyer default. That is called, bill co-acceptance. So friends, let's end our lecture here. The remaining part we will cover in the next module. I hope you enjoy the session. We have covered the most important aspect of it. So we have covered module B and module C in just a single lecture, right? So it was useful. Please, if it was useful, if you want me to bring more such videos for module D and module E, please write yes in the comment section. I will bring more such video. And if you really like it, please hit that like button, share with your other